Then taxes and revenue. So if we talk about taxes, taxes, I've given the hint before also that there are deferred taxes and current taxes. So revenue or the profits as per books may differ from profits as per tax return due to permanent differences and temporary differences. So whatever profits are calculated because of the temporary differences, the taxes will be paid either extra as compared to the books or lower as compared to the books. Right? Why so? First of all, what are permanent and temporary differences? Permanent differences generally means the which the tax provisions have allowed you to take permanently. That means in near future or in later future also, the books and taxes will never match. Those are permanent differences like tax exempted income, non-deductible expenses. Temporary differences are mainly due to the recognition of time differences. Just because of the time difference, books have reported it earlier than the tax, or tax has reported it earlier than the books. Okay. So, for example, if we talk about depreciation, for depreciation under books, as we saw that we can use either straight line balance method, WDV method, or double declining balance method, or sum of year digits method, or unit of production method. Whereas under tax provision, there is only one, which is MACRS, which is Modified Accelerated Cost Recovery System, which is a combination of straight line balance method and double declining balance method. So, what will happen? Let's say you have bought an asset of $20,000, which has useful life of 5 years. Okay. As per books, if you are using straight line balance method, so simply you will be reporting 4,000 every year as a depreciation. Correct. Whereas as per, let's say, Makers, since Makers use SLM and DDB, it starts from DDB. So in that case, first year may be same, but second year it will be 20,000, $16,000 into 2 by 5, which comes out to be 6,400. Now, if you see the second year, as per books, you are using 4,000. So let's say sales minus expenses. So the gross profit coming out as maybe 50,000. Other expenses maybe 10,000. And depreciation as per books 4,000. So net profit as per books is coming out as 36,000. Whereas if you go for calculating it through tax purpose, it will be 2,400 extra deduction. So net profit will be lower. It will be 6,400. No, so 2,000, 33,600. Okay. So the tax will be calculated as per books estimated on 36, but in actual it was calculated on 33,600. So let's say 20% is a tax. So into 20%, it will be 6,720. Whereas in actual, in books, you have to report it deferred and current. So current tax will be 6720. Total tax you have to report is 7,200, which is 20% of 36,000. So extra 480 should be reported as deferred taxes. Deferred taxes means these taxes will be paid maybe in the next year. How it will be reported? How it can be utilized? So here if you see 16,000, 6,400. Now in the next year, in year 3, the depreciation calculation will be 9,600 into 2 by 5. Right? So 16,000 minus 6,400 is 9,600 into 2 by 5, which comes out to be 1920. It will be somewhere around 3840. Right? Now, if you see here, it is higher than the tax provision. So this 480 will be adjusted in the next year up to 160. $160 out of 480 will be adjusted in next year, and remaining will be adjusted in fourth and fifth year. Okay. So this is how the tax is calculated and reported. Then we have revenue recognition. Revenue recognition is a 5-step method, which in general you will not even be able to realize that 5 steps have already been happened. Okay. So first step is identify the contract. So that can be like an invoice or an agreement or engagement letter, right? So whatever is mentioned in the contract that you have to sell and one has to pay will be given. Then identify separate performance obligations in the contract. So separate performance obligation means buyer has to pay as a, so performance obligation for buyer is payment. Seller's obligation will be to send the goods or services. Okay. Third, determine the transaction cost price. The price of the total goods or the total services to be provided. And fourth will be allocate the transaction price to performance obligations. Performance obligations. Again, same, like whatever the transaction price you have mentioned for each goods, then you have to just multiply it with the number of goods or number of services you are providing. So allocating it to the performance obligations. And fifth, recognize revenue. Recognize revenue when performance obligation is fulfilled by seller, not the buyer. Why so? So if we say that buyer has given the payment, but seller has not given the goods, so you call it as advance and not as a revenue, right? So it is cash to advance from customer, right? Whereas if you are sending the goods, but you have not received the cash, you report it as accounts receivable to revenue or sales, right? So idea behind revenue recognition is when you can consider the transaction as sales or revenue in your books is known as revenue recognition. Lastly, we have for this section A, the last thing that we have is IFRS difference. So US GAAP versus IFRS difference. Generally, more or less, it is almost similar. There are certain differences that you can read and check. Like it's just the theory part that you have to focus on. There is nothing in detail that you need to check since these are not heavily tested in exams. So I think just reading will be fine. Reading from the book will be fine for IFRS differences. Okay. So let's before starting. So section A is over now. So before starting section B, let's take 10 to 15 minutes break. Maybe we can come at